Welcome to my channel. I'm the Cover Call Guy, and my goal is to create $120,000 in passive income. Currently, my portfolio yields about $72,761 and $78. There's my monthly, weekly, and daily. I would say, but it's a tongue twister here. Today's video is going to be on MAGY. This is probably my third video, but I get a lot of questions from why MAGY is a core satellite, right? I get like, oh, why invest in MAGY, right? Total returns is okay. It competes with SPY, but doesn't keep up with QQI. The NAV return is okay, not so great, right? I don't want to reinvest a percentage back just to make up for the NAV loss, but they don't understand the actual difference between NAV loss and market downturns. Huge difference. And they say, oh, well, in a true bear market, MAGY would be on life support, which I say is not true. In a true bear market, which stock itself, not even cover call ETF, is not going to be on life support, right? I mean, it just makes no sense. I had to make this video to really debunk a lot of those misunderstanding myths or just people just spewing lies, right? So these are the facts, fact checked. You let me know what you guys think. I think MAGY is literally the ultimate weekly core satellite position, however you want to play it. But for me, I'm building it to a $175,000 position where it pays me at least $1,000 a week. Legal disclaimer before we start. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. Now, with that out the way, today's video is, of course, about MAGY. Magnificent 7 for superior yield and defense. That's why I have it. All right. My quick take, the instrument is MAGY. Is it a specialized instrument for monetizing high implied volatility of mega cap tech stocks, the MAG 7? It overlays a weekly cover call strategy to convert equity volatility into consistent cash flow. This pays weekly, typically, I believe, always on a Monday. The X day is the Friday, and then it pays the following week on a Monday. My thesis behind this is that while upside is capped in a raging bull market, MAGY functions as a volatility harvest sleeve, right? It offers superior income and defensive utility in a choppy regime, a choppy market, cushioning down drawdowns through structural variance risk premiums. It feeds on volatility. It feeds on choppy market. It feeds on fear, right? It feeds on that fear of missing out or fear of sell-off. So it captures both. Quick sneak peek, right? Target investor, income-focused investors like myself and maybe like you if you're subscribed to the channel. This channel is all about cover call ETFs and income investing, right? Income-focused investors willing to cap upside for high immediate cash flow and lower portfolio beta. Yield expectations, high teens to mid-30s annualized. Right now, I believe it's 19 to 20 observed in November 2025. So if you're watching this in a later date, it could be wrong. It is these yields are as of observed to, this month, November 28th, 2025. The portfolio role, I would consider a core satellite or satellite, depending on how you want to play this. Income sleeve, 5 to 15% allocation, providing uncorrelated yield from single stock volatility, right? It's meant to pair up and complement a core position. This is not for you to make it a core position. You want to complement it with a core position, maybe a monthly cover call ETF. And while this pays you weekly, you have some income to play around it with it every week. Okay, it is not meant for you to have it as a core because it's very concentrated, it's weekly, and it caps upside. So you want to complement this with an actual core position, whatever you want to choose. Right? It could be another Q, it could be SP 500, however you want it. The yield revolution. Traditional income is broken. Forget relying on bonds that barely beat inflation. This is why I picked MAGY, because it offers a new a new path towards unfixed income, right? I don't want, I want to get paid every week. I treat this as a paycheck, where if um, traditional income, you might invest in bonds or some hard uh, fixed asset, you might not be able to outpace inflation. I like Maggie because it pays weekly. It can beat inflation, right? It goes with the market, right? Instead of hoping for my safety, Maggie turns the market fair, which is IV, directly into my weekly paycheck. It harnesses the philosophy of Mag 7 to generate income that traditional assets can't touch. I have high conviction in the Mag 7. I don't think it's going anywhere. If it changes, then it changes. It's still going to be the Mag 7. It has a moat. The whole point of Mag 7 is that it basically dominates. It's basically the country, right? The GDP itself, the, the the market share, the market value. These companies have such a stronghold. It's not going anywhere. Structural advantage, right? Monetizing volatility. Maggie differs from broad funds like SPY by focusing on a narrow basket of high beta asset. The Mag 7 commands higher IV than the SP 500. In a market correction, the fear gauge rises because Maggie is effectively short volatility via sold calls. It benefits significantly from this repricing. Right? The whole point of this is to try to grab as much as uh, the highest premiums as much as possible for that weekly pay. The volatility school example: standard weekly call options sold 2% out of the money. Right, low volatility, the IV 35%, 0.60% premium as percentage of notion, versus high volatility IV is 60%, 1.40% premium as percentage of notion. The impact of this is that in a crash, the cash buffer generated by the option more than doubles. This extra 0.8% per week is the structural cushion that mitigates NAV decline. So yes, it won't buffer your drawdowns as much because it's not a hedge. If you want a hedge, then you buy something else. It's not going to go up with the raising bull market because it's an income play. This is a pure income play. This is not here to try to stay with the market like Neo's ETF does, right? It doesn't have a dynamic overlay like the QQQI or the Goldman Sachs funds. This is a pure income play to complement your core plays. The strategy engine. It uses long exposure, hold equal weight exposure to the Mag 7, right? Apple, Nvidia, Microsoft, capturing the core innovation engine, right? It writes on the MAGs, MAGS. So it indirectly holds the Mag 7. It write calls, systematically sell weekly out of the money call options against these holding, targeting high implied volatility. And then it harvests these premium, collects rich option premiums, which is the income regardless of market direction, distributing them weekly. Yield superiority, right? So Maggie, this is the target of 25%. QQI, the tech, 14.5%. SPY, the broad bar market, 11.8%. 10-year treasury at 4.2, SP 500 at 1.4. Maggie's concentration in high volatility assets allow for significantly higher premium options compared to broad index funds. So, again, this is a pure income play. Treat it as such. Right? Competitive landscape, right? We compare it to QQI and SPY. The underlying Mag 7 stocks versus NASDAQ 100 or SP 500 volatility source, right? It's very high because it's basically it's an idiosyncratic stock, meaning individual, right? It holds singular stocks, which is the 7 stocks. So um, it is high in terms of volatility source. That's what the premiums come from versus a sector beta or market beta, right? And then indicative yield, they try to aim for 20 to 35%. QQI is 14%. SPY is 12%. Expense ratio is quite high at 0.99 versus 0.68. The best is for when the market is sideways or high volatility. My QQI is bull market and SPY is core low volatility, right? And again, important, MAGY is not a growth play. If you want growth play, these two right here would be your growth play, right? It is a pure income play. Expect minimal growth capture in a strong bull market. Treat it as such. Right? This is to complement these two. Is not to be treated as, oh, I'm going to put this as 20-25% of my portfolio. Please don't. Keep it to 10, at most 15, right? This is a core satellite position or satellite position if you just, whatever, is my one single weekly and I don't really care about it, right? Or it's like, okay, I do care about it. I'm gonna keep an eye on it, and if it dips a little bit more, dips a little bit because of the market, right? The market is going down. I'm a dollar cost average into it to increase my weekly payout, right? So understand when people tell you that, oh, why invest in Maggie? Because I want a pure income play. It has minimal growth. It has no NAV erosion. It has no NAV erosion right now. The market is down. It follows the market and it goes down. The 7 stock is down. This stock is also down. So understand, there's a huge difference. Cushion versus protection, right? So Maggie does not offer hard protection. Maggie provides a cushion via premiums, not hard protection like a put option. When the market drops, implied volatility, the IV, spikes. Maggie sells into this fear. If the market drops, the fear premium collected offsets a portion of the share price decline. The net result, a softer landing that preserves capital for recovery. Stress test, November 2025, Maggie versus Mags, the underlying. Mags dropped almost 10%, while Maggie almost just dropped about 6%, right? The outperformance is 194 basis point. The options premium successfully offset 25% of the decline. Hypothetical drawdowns, again, this is hypothetical. Please, I'm kind of guessing just based on numbers, and I put a little bit higher and I put a little bit lower just to see how it would return against mags. So in a mild bear market, right, Maggie has a better cushion. In a crash, Maggie does slightly better. In a flat, Maggie does better. And when the market rips, Mags completely dominates Maggie. Mags is a pure growth versus Maggie a pure income. Okay? Let's not get those mixed up. Let's not compare a pure growth versus a pure income. There's two completely mindsets here. Path risk, right? The V-shaped lag, the recovery trap. While Maggie outperforms in a drop, it faces path risk during a violent recovery. If the market drops 10% and instantly rips back 10%, Maggie will lag. Because calls are sold weekly, a sharp rebound result in shares being called away at the lows, forcing the fund to buy back higher or capping the recovery. Deconstructing the NAV erosion, right? We have optical erosion. High distribution funds see sharp price drift lower because the dividend is deducted from the NAV. If the NAV pays 20% but the asset grows 10%, the share price must drop 10%. Economic reality, if the total return price plus dividend is positive, the investor has not lost money. They have simply converted equity into cash. Do not conflate price drop with economic loss. A lot of people will do that, and they'll say, oh, NAV erosion, NAV erosion, NAV erosion. And then when you do total return, it's like, well, actually, no. It's just going along with the market. The market drops, this drops. The market goes up, this goes up, right? So understand the two difference when people are arguing with you on whether Maggie does this or not. Reinvestment math, of course, I always got to put this in. Example, investor with 20% yield will use Maggie if it has a 20% yield. Spend 70%, right? 14% spendable cash flow versus reinvest the 30%, 6% capital buffer added. Since this is a pure income play, this reinvestment strategy buffers against tax drag of non-qualified distribution and preserve principal. And it also helps with inflation, right? This is a pure income play. You want to use that income to kind of offset inflation so you can have your core to do whatever you want to do. All right, this is to complement your core. Remember that. Return of capital, right? Is it good or bad? Constructive return of capital. The fund generates cash via premiums but holds stock with unrealized losses. Allows tax deferred cash flow while portfolio value remains intact. What is destructive capital? Destructive return of capital. Fund pays out more than its combined premium plus appreciation capability, liquidating the core portfolio over time. My verdict here is that given Mag 7 volatility, Maggie's premium are naturally rich, making distribution largely a function of mechanics, not liquidation. Of course, the keyword here is the Mag 7 volatility, right? So in a drawdown market, we will have to see how this performs. Again, we depend on the Mag 7. So if the Mag 7 drops and this drops, it does not necessarily mean it's NAV erosion. Risk assessment, right? Concentration risk, of course, like I mentioned, is only 7 stocks. A regulatory hit to any big tech antitrust impacts the entire portfolio. Capped upside in a raging bull market, Mag 7 plus 40%. Maggie will significantly lag, anywhere from 15 to 20% as gains are paid out. Tax efficiency, options may be treated as ordinary income or short-term gains, increasing tax drag versus 1256 contracts. Expense ratio at 0.99%. The fee is high relative to a little bit more passive ETF, justified only by active volatility management. So keep all of these in mind, all right, when you're trying to find a core satellite or satellite position to complement your core. Keep these in mind. All right, of course, which suits Maggie the best, right? In a sideways market, Maggie will dominate. When stocks stall, Maggie's yield creates massive outperformance versus flat equity. When it's volatile, as Maggie performs strongly again, high volatility means rich premiums. The cushion shines here. In a V-shaped bull, Maggie will lag. In a violent rip upwards, cap calls limit gains. Shares may get called away. So let's keep all of these in mind. A core satellite strategy, right? Build a core SPY or QQI, right? Orbit it with a high yield satellite like Maggie, which is what I'm doing myself, right? They structure balanced broad market stability with massive income potential of the Mag 7. Harvest volatility to fund your safety, right? I'm using Maggie to fund everything else, to build everything else. It's to complement everything else. As it pays me $1,000 a week, I'm using that to pay bills, reinvest, to build other positions, right? While my core just keeps building, or I'm using my core as other needs, right? Use it to complement every other position. It's not meant for you to be using this as a core and something happens to it and now you might have to do a sell-off. That's the worst case scenario. Don't treat core satellite positions as a core, because what happens is it can be very, very unpredictable. And then if it's not very stable, right, because the Mag 7 can't change at any time, right? It's something that can happen to it, like I mentioned in the previous slide. Then what happens? You have to ask yourself the question, what is the backup here? My verdict, Maggie is a sophisticated tool for income-focused investors. It converts the uncertainty of Mag 7 into a predictable weekly paycheck. So even if this Mag 7 is can be uncertain, right? What is predictable is a weekly paycheck. Thanks for watching. Subscribe, like, comment. I feel like I had to make this video again just because I've mentioned that it was going to be a big position in my portfolio, and when I mean big, I'm investing anywhere from $150,000 to $175,000 into it, paying me at least $1,000 a week. That is my goal for this position. And then I get a lot of questions and I get a lot of pushback, and as you heard in the beginning of the video that, oh, it doesn't match up with QQI. Why would you do that? This position is to complement the rest of my Qs, right? QQI, GPIQ, KQQQ, there's another satellite position, is to complement my core Qs. This is not a core, right? It's a core satellite slash satellite in my position. I'm keeping this as I'm using this backup to back up my core. If that makes sense, I hope it makes sense. If it doesn't, let me know. I'll try to break it down some more. But as long as you understand the risk with core satellite positions, you will be just fine. All right. Don't treat core satellite position as your top core positions, and you end up having to sell off positions because something happened to um, your satellite positions. That is not what we want to do here. Thanks for watching, guys. Stay tuned. Catch you guys on the next.